You may remember that a couple of weeks ago I did a video on how to increase the cash flow in your property if your mortgage reset has increased your payment significantly. And one of the options that I didn't mention in that video, because it's a bit more of an advanced option, I'm going to talk about today in this video. It's a topic that I don't think gets talked about enough in Canadian real estate, and I think right now, given what's happening with interest rates and the rental market in general, that it deserves a serious look. We're going to talk about rent-to-own agreements, also known as lease options, and specifically how they can work as a strategy for property owners who are struggling to cash flow their properties the way they used to. Now, I've used this strategy myself, and I want to talk you through how it works, why it makes sense, and what you need to have in place to do it properly. So, let's get into it. But before I do, I just want to make a quick disclaimer. I'm not a lawyer, and nothing in this video is legal advice. I'm sharing this from my own experience as a Canadian real estate investor. For anything legal, and especially for setting up one of these agreements properly, you're going to want to talk to a real estate lawyer in your province. Okay, now let's get into it. So here's the reality that a lot of Canadian housing providers are dealing with right now. A lot of people bought rental properties between 2018 and 2022, properties that made sense at the time. The numbers worked, the rents covered the mortgage, there was a little bit of cash flow, maybe not a ton, but it was manageable. And then interest rates went up significantly. And suddenly the property that was marginally cash flowing or even just maybe breaking even is now losing money every month. Now, if you're in that situation, you basically have a few options. I talked about those options, like I said, in a video I did a couple of weeks ago. If you didn't see that video, you can check it out. It's this one right here. Go have a look at it, and it'll give you some really great ideas on how you can increase your cash flow if your mortgage has reset and you're paying several $100 more a month. But you can have those few options. You can sell the property, you can raise the rents. There's a couple of different things there. Or this is what I want to talk about today. You can explore a rent-to-own or lease option arrangement. And this isn't just about cash flow problems either. There are other really good reasons that a housing provider might consider this strategy. And I'll get into those too. So let's make sure we're all on the same page here on what this actually is. A rent-to-own agreement, sometimes called a lease option or lease-to-own, is essentially two contracts combined into one arrangement. So you've got your standard lease agreement, like you would with any rental property, with any tenant, which covers the rental period, the monthly rental amount, and all the usual landlord-tenant obligations. And then you've got a separate option to purchase agreement, which gives the tenant the right, and sometimes the obligation, to buy the property at a predetermined price within a specific time period. Now, there's an important distinction here that you need to understand because there are two main types of these agreements in Canada. The first is a lease option agreement. This gives the tenant the option, but not the obligation, to purchase the property at the end of the term. If they decide not to buy, they just walk away. They will lose whatever option fee and rent credits they've built up, but they're not legally forced to complete the purchase of the property. The second is a lease purchase agreement. This one is more binding. The tenant is committed to purchasing at the end of the term. And if they can't get financing or decide they don't want to go through with it, they are in default. This one carries more risk for the tenant buyer. And honestly, as a landlord, I'd lean toward the lease option structure in most cases because it tends to attract more motivated buyers who have a realistic shot at getting a mortgage in the end. So how does the money work? Typically, you've got three financial components. There's the option fee, and this is an upfront, non-refundable payment that the tenant buyer makes to you at the start of the agreement, just for the right to purchase the property later. It's like a down payment, but not a full down payment. The amount can vary depending on the purchase price. Then there's an extra portion that's paid monthly throughout the term, which is credited toward their future down payment. Just let's say that the down payment is $50,000. That's a 10% down payment on a $500,000 property. In a rent-to-own deal, they might pay $20,000 for the deposit, and then that extra $30,000 is divided into monthly payments spread over the term of the lease and goes into a credit toward their purchase, so that by the time their lease term is over, the full down payment or most of the full down payment has been paid for the property. So over a 2 or 3 year term, that'll build up the full down payment, and then you'll want to confirm that with a real estate lawyer before you finalize anything to make sure that the documentation is correct. The monthly rent then is the second portion of that, and the tenant pays a rent amount that's typically the same as market rent, just pays market rent, and that's just like any other regular tenant with a separate tenant lease agreement in place. So you have the option portion with an option agreement, and then you have the rental agreement. And then the third portion of that is a predetermined purchase price. You and the tenant buyer agree on the price the property will sell for at the end of the term. That's locked in, regardless of what the market does. So let's talk about why you as a property owner might actually want to do this. And I'm going to go beyond just the cash flow issue because there are actually quite a few reasons this strategy makes sense. The reason number one is turning a negative cash flow situation into a positive one. This is a big one right now, of course. If your mortgage has reset at a higher rate and your rental income no longer covers your costs, a rent-to-own deal can bridge that gap. The market rent you're collecting plus the monthly option fee payments can be enough to get you back to break even or positive cash flow until the sale of the property concludes. Reason number two, you lock in a sale price today in a market that you understand. So if you think you need or want to sell in 2 to 3 years, this lets you lock in today's value or slightly above it while giving yourself time to get there. You're not gambling on what the market looks like in 3 years. You've already agreed on that number. And reason number three is the tenant buyer tends to treat the property better. This is a big one that I've seen firsthand. When someone believes they're going to own the property, they'll treat it completely differently than a regular tenant. You can build into the contract that they fix the small things themselves at their expense, and they'll take care of the yard. They'll invest in it mentally and emotionally. And for you as a housing provider, that means fewer calls, less maintenance headaches, and a property that's being maintained like an owner would maintain it. And then number four is you reduce the vacancy risk. Vacancy is one of the most painful things for a housing provider. In a rent-to-own deal, you typically have a committed tenant buyer on a 1 to 3 year term. They're not going anywhere because they have skin in the game. So that option fee that they paid into, that will be forfeit if they leave. So your vacancy risk essentially goes to near zero during the agreement term. Reason number five is it opens your property up to a bigger pool of motivated buyers. There are a lot of Canadians right now who want to own a home but can't quite get there yet. Maybe their credit score is a bit low, or maybe they're self-employed and their income documentation doesn't satisfy the banks. Maybe they're newcomers to Canada who don't have a long enough credit history yet. These people are motivated, they're serious, and they're actively working to improve their financial situation. A rent-to-own gives them a path, and it gives you a highly committed tenant in the meantime. Reason number six, higher vacancy in your market. If you're in a market that's experiencing higher vacancy, and we've seen pockets of that all across Canada, a rent-to-own arrangement will help you fill a property and generate income on a property that's been sitting empty. Even if you weren't originally planning to sell, the economics might make sense depending on the deal structure. And reason number 7 is that it can be a planned exit strategy. If you're thinking about offloading an underperforming property over the next few years, this is actually a really elegant way to do it. You'll sell, but you don't have to move out your existing tenant. You can give a current tenant the opportunity to buy. You generate cash flow for 2 to 3 years in the meantime, and then you exit cleanly. Now, before I get into what needs to be in your agreement, I want to make something really clear. Rent-to-own agreements are not something that you Google a template for and piece it together yourself. Every province in Canada has its own residential tenancy legislation, which we know, and the rules around how these deals need to be structured can vary. I'm not going to get into the specifics of each province here because honestly, that's not my job. That's your lawyer's job. But what I will tell you is this. You get a real estate lawyer in your province who has experience with lease option agreements and have them draft or at minimum review an agreement that you have before you sign anything. This is exactly the kind of situation where spending a few $100s on legal fees up front can save you thousands and a massive headache down the road. This is a business, so you need to treat it like one and get the right professionals involved. So let's talk about what a solid lease, a rent-to-own agreement looks like. And again, this is where your lawyer earns their fee, but you should understand what it is that you're getting into. So first is the purchase price. This needs to be locked in. And you need to decide, is it at today's value? Is it today's value plus a predetermined appreciation amount? You need to decide that up front and get that into the contract. Second is the option fee. How much is it? Is it being credited toward the purchase price? What happens to it if the tenant buyer defaults or walks away? Generally, it's non-refundable to you as the seller if they don't buy. That's one of your protections. Monthly option credits. How much of the monthly premium is being credited toward the down payment? How is it being tracked? Is it held somewhere? In some provinces, there are requirements or strong recommendations about how these funds get managed throughout the term. And then there's the term length. Typically, you're going to be looking at 1 to 3 years. And that's long enough for the tenant buyer to clean up their credit or save additional funds, whichever might be the case. But it's short enough so that you can see a light at the end of the tunnel and you're not locked in forever. Maintenance responsibilities. This is different from a standard tenancy. In a rent-to-own, it's common and actually favorable to you, the seller, to shift more of the maintenance responsibility to the tenant buyer. After all, they're treating this like their home, so they can be responsible for some of the maintenance items. And get this spelled out clearly in the agreement. What items will be their responsibility? Is there a dollar value that they cover up to a maximum of so much, and then from there above, you will take care of it? What is that? How is that going to look like? And then there's default provisions. So what happens if they stop paying rent? What happens if they damage the property? What triggers the option becoming null and void? These provisions will be in the contract to help protect you. The purchase process at the end. So how does the tenant exercise their option? What's the notice period? Who pays the closing costs? And how does the title transfer work? All of that needs to be in the contract. Now, I'm not going to sit here and tell you that rent to own is a perfect strategy with no downside, because that would be dishonest. There are legitimate risks, and these things you need to be aware of. The tenant buyer doesn't qualify for a mortgage at the end. This happens. Maybe their credit didn't improve the way they thought it would. Maybe the bank tightened its lending criteria. If you're in a lease option arrangement, they simply don't buy and you keep the option fee and the credits, and now you have to find a new tenant or a new buyer. If you're in a lease purchase arrangement, you may be in a legal dispute. This is one reason why I prefer the lease option structure, because it's an option, and if the tenant can't or won't close on the deal, they can walk away and there's no legal disputes. The market moves significantly. So this could be another reason why they wouldn't close. So if you've locked in a price today and the market drops, for example, dramatically, the tenant buyer might just walk away. They're not going to pay $450,000 for a property that's now only worth $380,000. If the market goes up dramatically, you may feel like you left money on the table. And that's okay. You locked in a price and the property is worth significantly more. That's the trade-off. Tenant protections still apply during the rental phase. Just because someone is a tenant buyer doesn't mean you can bypass the residential tenancy legislation in your province if things go sideways. If they stop paying rent, you have to go through the proper legal channels to remove them. That's why tenant screening is still critical, even in a rent-to-own situation. The agreement needs to be airtight. A poorly written rent-to-own agreement can create enormous headaches, so make sure yours is done correctly. And speaking of doing things right, I want to make this point because it's important. Just because a rent-to-own tenant has skin in the game doesn't mean you can skip your screening process. You still need to check their credit. You still need to verify their income. Still need to speak to their previous landlords and do all of your due diligence and your background checks. Maybe even more so with rent-to-own, because if this person is going to be in your property for 2 or 3 years believing they're going to own it, and then they don't qualify for a mortgage, you want to make sure that you had a good tenant in there during that entire period. You also want to make sure that they have a reasonable chance of qualifying for a mortgage at the end. The rent-to-own tenant is someone who has a solid income and a genuine plan to get their credit back on track or get their down payment in order. Not someone who's hoping things will work out and just gonna fly by the seat of their pants. Screen for intention and a realistic path for ownership. Okay, so let's tie a bow on this. Lease options can be genuinely a smart strategy for Canadian investors in the right situation. If you're struggling with cash flow due to higher mortgage rates, or if you're dealing with higher vacancy in your market, or if you're looking for a cleaner exit strategy over the next few years, or if you just want more committed investment tenant taking care of your property prior to sale, this is absolutely worth exploring. The fundamentals are straightforward. You've got a lease agreement, an option to purchase, an option fee up front, and monthly option credits toward the purchase, and a locked-in sale price. The tenant gets a path to home ownership. You get better cash flow and a committed tenant and a planned exit. But, and I'll say this one more time, get a real estate lawyer in your province involved before you move forward. Have your agreement drafted or reviewed by someone who knows what they're doing. The residential tenancy legislation in your province still applies during the rental phase of the arrangement, and this is a deal where the paperwork really matters. Done properly, it's win-win. I think it's a strategy that more Canadian investors should at least have in their toolbox. It's not right for every property or every situation, but when the conditions are right, it can actually be a really elegant solution. If you found some value in this video and you maybe gave you some new way to think about your portfolio, especially if you're dealing with some of the cash flow challenges that a lot of investors are facing right now, don't forget to like this video and subscribe. It really helps other real estate investors to find this content as well.